Right, I wanted to make this video really similar to what we did on Saturday, with a few extensions. This is a training purposes for using the front-running template on Ensign. It's a new approach I've discovered at how to front-run the dome and the ergodic and everything else by looking at decreasing momentum. I think you'll find it pretty interesting. Um, Took about 2 years to figure this out, so here we go. First thing we always do is a CFTC notice that tells you that we're not trying to get you to buy, sell, or do anything with commodities, options, futures, or anything else. You shouldn't trade with money you can't afford, and you should know that you can always lose more than you have in your account when trading this way. So with that said, let's move right on. Now, my original Futures Trading Secrets course, which took about 200,000 tests and a couple of years to develop in the first place, we introduced the ergodic indicator as a non-lagging indicator because it is a triple derivative of the price, and when set properly, it will not lag what your moving averages are, like your moving averages or your MACD or anything else. So we've had over the years thousands of students worldwide have used it to make exceptional profits, trading everything from Forex to the E-mini to the Russell to whatever. It works exceptionally well for finding the turns to do new directional trades with options on stocks, and there are a lot of ways that you can use it. As far as I know, Ensign is the only program that has the ergodic indicator set up the way it does. The system itself got hacked in 2012 and was given away by the Russians and others. At one point, there were over 16,000 links to free copies of my 2008 program. They never figured out that those were all encrypted, so everybody at the bottom lost their money. But it did kind of kill the trading business. I also discovered that every other trading program in the world was hacked the same way. So people who want to get stuff for free just do that, and they're too lazy to do their own work. So this is the first update I made since then. It took me a year and a half to kind of just mentally recover from all that. So I'm going to show you what I learned that's making a lot of money in the market right now. So just to review, this is the original system. You see the downtrend with the red bars continuing down. And you get a Pesavento bar, the green arrow at the bottom. It tells you when you're at the bottom. Now those arrows do move, but in conjunction with the ergodic, which is a purple and white indicator down on the bottom, the yellow line is its moving average, and the red line is a long-term ergodic. You can see that the turns happen, and you can literally almost trade tops and bottoms. Now the only challenge is to keep from being washed out with strange and wonderful moves of the market. I always insisted that people wait until the white bar crosses the yellow bar, and you see that happened at 1450 cents. The market then ran all the way up to 1404. That's a 3.5 point move. To get a doji, you get a Pesavento bar, which is a Fibonacci number at 0.618. And at that time, the ergodics are still going up. And so we had to solve a problem that you could get out right at that number. And if you take a look at this, you'll see that the ergodic does lag in this particular case just because of where the market's been and where it's going. Now, when the hackers gave away all these encrypted files, I thought they were smart, but we got them anyway. But they did give away about 33,000 copies of my old program, and so I had to go back in and revise the manual, revise everything, and this is the last revision. I also wanted to be able to front run the high frequency traders. If you're familiar with the dome at all, you'll know that the HFT trades do never appear on the dome. They're too fast. A friend of mine was a market maker for a bank in Chicago, and he found doing some analysis that one of those little dojis in the middle of a trend, okay, contained 35,000 trades in and out, just trying to make a quarter of a point. We don't have to worry about that because it doesn't affect our overall bigger trend. So this upgrade uses a dome of buying and selling pressure as an early warning signal, and it's actually an adaptation of the bid-ask spread ratios. It's only available on Ensign. You can't do it on TradeStation or any of the other charting programs out there. Even the ergodic and things are not available on Thinkorswim. So it has been achieving 80% winners. I'll show you that now. Now this is the dome from ATC Brokers. If you look at the red numbers and the green numbers, those are standing limit orders to exit or enter the market. The limit sells were 7,000 and change, and limit buys are 8,100, with a difference of 1,100 positive in the direction of the buy market, which says the market should go up. But there are so many spoof orders in here that you never know what's real and what's not. A lot of people put them in, put them out, put them in, put them out, trying to move the market or jazz it forward. And again, HFT never shows up here. So what I decided to do was measure and graph these and see what I could figure out and compare it to the ergodic indicator. So this is last week. I've got 4 things itemized here, A, B, C, D, and E. And what we're looking at is real, true momentum and the change in momentum. Now the ergodic does that. If you look at point A, right at the change, it's right at the peak. But how do you tell if it's really going to turn around or keep going? Because most of you know those Pesavento patterns move, and they can move continually in one direction, and you can get whipsawed and wiped out going the wrong way. Well, if you look down here at the green, which is the buying pressure, and the blue, and the purple and yellow are the selling pressure, you see the buying pressure has dropped off just a couple bars before, and the selling pressure has started to increase. So those are guys distributing their profits right there. And as this takes off, the market goes down. Now again, same thing, principle going in the opposite direction. You get a Pesavento bar at the bottom, but you see how the selling pressure dropped off and the buying pressure started to kick in just at the change on the ergodic. So technically, if you get good at this, you don't need to wait for the ergodic to cross its moving average. It's always safer, and I encourage you to be safe. It's your money, remember? But that is the way it works. So here we go. These are fairly big trends with that, and these are moving averages of the buying and selling pressure. So again, the market starts up, and this is where you can get confused. It started up and it stalled. Why did it stall? Buying pressure kind of dried up and selling pressure started to increase. But as long as the buying pressure is greater than the selling pressure, the market is most likely to continue up. Now when you get the cross right here, okay, it's also a color change on the ergodic, it's likely you're going to get a pullback. And from the course, if you remember, usually those pullbacks come back to the moving averages, and away they go. The second thing, when the 49 crosses the 89, that is a very good sign there's going to be a big run up in the price. So if we look at E here, buying pressure went way up, selling pressure went way down. And finally, when you get up here close, it starts to slow down. It's like putting the brakes on the car, and you get ready to go in the other direction. So this was around 11:30. I think it was Wednesday or Thursday. Here we are again, same principle, same idea, just looking at what happens at A and B. A and B, you see the momentum switch. The buying pressure goes away and the selling pressure increases. The ergodic changes color and comes down, so you've got a mini divergence here. So there's a third part of a signal to say time to go bye-bye or reverse the way you're going. You'll also notice that up here, from 2034 to the moving average of 2031, you're greater than 2 points away from the moving averages, and that's also a good turning spot. You also had a lot of Pesavento bars here, including one from the bottom and 3 from the top, which is a triple signal, I guess, if you will. So now the market starts sliding down, kind of hangs up on the resistance of the moving averages, and then falls off a table again. But as it falls off a table, all of a sudden you can see the selling pressure getting smaller, the buying pressure getting bigger, and the color change on the ergodic. If you want to wait until you've got, the cross of the moving average, then so be it, you can do it. I've gotten to the point where I just trade the buying and selling pressure in conjunction with the ergodic color change. Okay, here's the end of that move, starting back up. You can see everything starting up. You could have gone in clear over here. Got the ergodic above its moving average. You got the selling pressure way up. Pretty safe move if you're up there. Okay, here's another one from last week. This is on the 2000 tick chart, I think. Yeah, 2000 tick chart. A little slower and more difficult to read, but again, if you're doing the candlestick stuff, you get a Pesavento bar. You get 2 dojis. You get the selling pressure starting to drop off and the buying pressure starting to come in. And you've crossed the from the white to purple, showing the ergodic is going down and the long-term ergodic in red is going down. So this is a pretty good move. Went from 43 to 36, 7 points, 160% on your money. Now, as things really start to slow down, you'll see the selling pressure really coming more and more off and the buying pressure coming in. And when you get a Pesavento bar and a color change, you can just hop in the bin here at 36, and it'll run to 37.75. You can never tell how far it's going to go, but when you start to get these turns down here, it's time to go bye-bye or you'll have a push trade. Okay, so the slides from last week use the same principles. The fun runner is 1 bar, or the front runner is 1 bar early, usually sometimes 2. You need to watch the ergodic, and the long trends in the price action are better to trade from because the action is much better on this buying and selling pressure. So this setup is locked to your computer. When you get this template, it will only work on the computer you're using with Ensign because you'll register it later. So here are kind of the indicators, nothing special. It's just 8 moving averages of Howard's moving average on buying selling pressure. Not a big deal, but takes a while to tune it up. So here's some more of the things we did for last week. Have the ergodic going up, you got the buying pressure going up, and all of a sudden it stalls out and selling pressure takes in. This comes down and obviously it's going to rebound off the moving averages here. Same thing again, you got a candlestick pattern up here, you got an increase in selling pressure, but it's not very long, okay? And when the ergodic is still way above the long-term ergodic, you want to think about staying in and being cautious. This is where you could take half off, hold the rest, or you could move your stop, up a little bit, depending on where you did set your stop, and the market takes off again. And finally, it turns over up here when all the selling pressure is exhausted, and the buying pressure, even though it's exhausting, is just telling you, it's about time to leave the market. If you look at the time, it's 16:07. You only got 8 minutes till the market ends, which is basically right there. Okay, that's just talking about the pressure and the use of the candlesticks, Pesavento patterns. Here's a nice long trend with retracement. My mouse wheel is loosey-goosey and it moves on its own sometime. Same principle. If you look at, item 4, selling pressure came down and started back up again, and buying pressure went down. So you had a nice run from 17 to 11. That's 6 points. Okay. Now you get the bounce. If you want to trade the bounce, you can. I don't generally trade the bounces on those. What I do is I wait for it to hit the moving average and let it bounce down again. Okay. The other secret, if you read the course in detail, when the 49 crosses below the 89, perfect spot to take a nice short. So that's at point 1. And point 2, it just goes down and stops at a support and resistance level. So you run from 2013 to 2009. Back up is the bounce. Again, I don't generally take those. You can if you want, but you could definitely over here, just before point 3, when the buying power goes up and the selling pressure really goes down, you could have gotten in here at 2011 and out at 2013. Again, we're at the end of the day, so got to watch that. If there's a big downtrend during a day, you're going to get a bounce in the last 30 minutes. Okay, this is something I tested with myself before I decided to share this. And I was doing what Pat Stewart did when he took every signal and made 112 points in one day. Here, I took every signal of these bounces with these changes. Okay, down it went, crossed, up it went, down it went, back and forth. This is a little 2-point range, and I got 80%. I had 80 wins against 20 losses. They weren't very big. You can see they're only a quarter of a point, okay? But since they're bigger than the losses, you had a net profit of $1,500, in about a half an hour. I think this is 12:16 to 12:34 in about 15 minutes. So this works if you can watch it very tightly. And this is the 500 tick. Okay, same thing again. I don't mean to beat a dead horse, but you see the selling pressure going up, the buying pressure going down. When it turns around, it nears the bottom, hits the doji, and up it goes. And by the way, what Jeff Hatch, the trader from Chicago, is these little dojis in the middle of a trend don't mean a lot. Okay, especially if it continues, because that's where the big HFT trades are going on. So again, we've done candlesticks. I like the doji at the bottom. Here's a big dark cloud cover at the top. If it goes down, it comes up. We've got a divergence, right? This is a divergence, a higher high on the price, much higher high on the ergodic. And that's a very good signal to say this puppy's going to move up strongly. And in this case, even if you got in here at the top at 2,250, it went to 2006. And you can see the momentum slowing in the buying and selling pressure, in increasing in the selling pressure. And that's an excellent spot to get out. Now you got an arrow here. Could it go back up? I don't know. But I trade what I see, not what I think or what I hope is going to happen. Okay, here we are again. Now, one interesting thing here, I think is part of the last slide, where it comes down, bounces off the moving averages, goes back up again, and then turns over. Now, you notice this is nearly a double top. And if you notice at the ergodic, you're going to get a turn right here. Now, based on what's happening with the buying and selling pressure, you're going to get the turn right there, and it's going to turn over and cross down through its moving average, and it'll give you that nice divergence trade you look for. Okay, I'm just running through some of those because I'm explaining them all as we go. Here's another example of what's going on. The buying pressure is going way down here. Selling pressure came up and kind of halted. When you get a signal like that, I stay out. I don't trade. Even though the ergodic's above a long-term ergodic, even though there's some potential for all this to move, if I can't decide, I stay away. And you can see that was, that was a pretty good decision to stay away because it's still going nowhere. and it still went nowhere. So when both the buying and the selling pressure are dropping off like this, it says to stay away. The ergodic is flat, going nowhere, back and forth, purple and white, purple and white. So when in doubt, stay out. Now, this is the question of the day. What do you do here? Okay. If you look at the ergodics, you have that divergence. Okay. It says it should keep going down, but you have the moving averages being the support. You've got the selling pressure slowing down and the buying pressure yet to speed up. Again, when in doubt, stay out. Okay, so where to go is nowhere. Okay, whoops, sorry. So one of the things you do if you purchase this program today, you'll agree to a non-disclosure and sign off on that and email it back to me. You'll install your Ensign ID number. This is a way to protect the templates so they can't get farmed out, given away, traded, whatever. And now the template will only work and you'll only be able to see it on your computer. So if you have two computers, you'll need to give me the ID of both of them. That means you're subscribed to Ensign twice, and I can set that up for you at the same time. So price for this little uptick and everything is $297, and you can send me an email about it, or you can click on the link I'll send you afterwards with thank you for attending. And as always, you can get in touch with me at futurestrading.secrets.com, and I will be glad to help you with any questions you might have. Okay, that's it. Thanks a lot. Hope you had a good time.